Here now to discuss all of that is Peter Tchir. He is head of macro strategy at Academy Securities. Peter, if nothing has been made clear, it is the fact that the economy has taken a hit, certainly perception-wise, even if most of the tariffs have been rolled back. This idea of recession, where are we with that? I keep hearing shallow recession as kind of the default scenario.
I think I've already moved to recession with a capital R. I think it's going to be deeper. I think the friction that's going on globally is going to cause a global recession, and we're not going to be spared. At the same time, right, we're cutting government spending, which I think is necessary. We've got to get the deficit down. But we've been reliant on government spending for the economy, so I think that's a hiccup here. The trade war, and I think we're close actually to upgrading the trade war to almost calling it an economic war with China. When we look at the DIME framework of diplomacy, information, military, and economic, this feels with China, this is growing beyond a trade war and runs the risk of being an economic war, which I think will be problematic for global markets.
Problematic for global markets, problematic for investors as well. What are you hearing from your clients at Academy Securities? What are they saying in terms of, how they can position themselves for the next 90 days?
I think everyone's just trying to, stay awake at this point. It's been insanely busy. It's, I mentioned one client. Feels like we're going through a TARP vote every single day, and the client pointed out at least TARP was scheduled. We're going through this crazy market. I think people are tired, but I think it's starting to sink in that there is so much uncertainty out there that people aren't going to spend money, that corporations aren't going to spend money, and I think that's the risk that's starting to settle in. Right? Yesterday we rallied off the back of, and I think it was good. Like, let's delay, let's see what we can negotiate, but that still leaves a lot of uncertainty out there. The global economy is under pressure. I think companies have still not priced this in. Investors still haven't fully priced this in. I think we get back to the lows, and I think we can be down maybe 30% from absolute peak. So we got down 20%. I think there's room for that to go through, and we'll bounce once in a while on these, positive headlines. But if we're really convinced that we have to have this economic friction, it's going to be painful. And I think Xi is quite prepared to go the distance with this, as is Trump. So I don't know what the off-ramp is right now.
Yeah, I mean, that's what I was going to ask, Peter. What is the best case scenario here? Even if we leave China aside, it's its own thing, it's its own set of negotiations. What else do we have? A bevy of bilateral agreements at some point? What does that do for the market, or for corporate America, for that matter?
Well, we've been thinking a lot about what these bilateral agreements might look like, and I think tariffs will only be a part of it, is my concern, right? I think tariffs are relatively easy to negotiate. I don't think tariff barriers are the biggest problem to trade. I think, really the 10% tariff Europe has on us on autos, is that really what drives U.S. auto sales in Europe? I don't think so. But my concern is that Trump, who is very, very focused on trade imbalances, may require quotas of purchases of U.S. goods. That might make these tariff negotiations harder. And he may also try and include language that restricts how much trade you can do with China, right? China was able to get around some of the earlier tariffs by setting up in Mexico, by doing things through Vietnam and other countries in Southeast Asia. So I think these negotiations won't just be about tariffs. They will try and incorporate something about quotas to get the trade balance, and may even have things that restrict what countries can do with China. So I think that's going to be far more difficult to do. And if China gets a whiff of that, and it's coming true, then it could get derailed. So hopefully it's just about tariffs. I think that'd be simple and easy and we can move on. I suspect it's not, because I don't see how you solve the problem of China trying to use alternate countries to get their products in here if you don't try and clamp down on it.
Peter, is there any scenario in which Europe at least messages that it's cooperating in some way with China? That seems to be one of the only ways that you might be able to turn the screws on President Donald Trump.
Yeah, and I think that's why he's going to try and push back in these deals he offers. I think we'll have some sort of restrictions on, what you can do with China. That's why I think this gets worse probably before it gets better, as everyone really has to figure out. I think China and Trump may make every country pick a side. Who's more important to you? I don't know that will happen, but kind of from the messaging, this goes well beyond tariffs now, right? This is about trade. This is about Trump wanting to rebuild the middle class. He wants manufacturing here, and I think he will push very hard to get that. So I don't know what an obvious solution is, and I don't think China will take this lightly either. What will they do to kind of try and force trade to them? Yet to be seen. I think they're going to use a lot of their own tariff sort of diplomacy. I think they may look at Taiwan and say, what can we do in terms of one country, quote unquote, two systems, to maybe impose duties? Because that is one real weakness the U.S. faces, is critical minerals, rare earths from China, but also all our AI chips are coming from Taiwan right now. That's right in China's sphere of influence. We don't think they'll do anything aggressive militarily. That's not something, we work with 30 generals at Academy Securities. We don't see military imminent, but we do see gray zone type activity and the potential to use tariffs or other sort of economic levers to fight the U.S.
And one of the economic levers that China has at its disposal is perhaps to sell U.S. treasuries. There was some worry about that, and that might be why treasury yields continue to climb, especially at the long end of the curve. Peter, why was the 30-year auction, which met fairly strong demand, not providing relief to the market today?
It's two small events, and I think it was good. We had pretty solid, what looks like, indirect bidding, which typically means foreigners. But again, I don't think that solves the issue of where we're headed. If we're not going to generate all this tariff revenue, where do we, how do we fight the deficit? We've now talked about upping military spending from $800 billion to $1 trillion, which I think would be really good and really interesting, and will let the military get a lot of new equipment. Having said that, that's not good for the deficit. So maybe they're starting to creep in some doubt about our ability to decrease the deficit, that the trade war is going to be inflationary, that it's going to put pressure on the U.S. economy, it's going to restrict what the Fed can do. So I think all those things are coming to play. And I do think a lot of countries, and not just countries themselves, but I think pension funds within those countries are going to be reducing their exposure to U.S. treasuries in particular, but U.S. assets, including corporate bonds. Two things that, the Mar-a-Lago Accord has some vague reference to, maybe countries will be forced to turn their treasury bonds into zero coupon perpetual bonds. Yeah, I don't know if anyone took that serious 2 weeks ago. Given what we've seen in the last week and a half, you might have to take that serious. I think all countries might reduce their treasuries to the extent they can, and pension funds. And then there's also chatter about raising revenue by charging fees to foreign holders of treasuries. All those things, I think, play against us. And this all just feeds onto me. I think what we are seeing right now is damage to the American brand, and we've traded off, and I think this could be the mistake, though I guess I shouldn't say any mistakes would be made by you, given what you said earlier, but that we've traded off trade imbalances for capital flows. We were massive beneficiaries of capital flows and global brand recognition, where people wanted to be affiliated with the U.S., they wanted to be associated with the U.S. I think that has taken a turn for the worse, and that's what we're seeing play through markets, and I think it's going to start hitting corporate earnings as well. So that's why I remain bearish that we haven't yet hit the lows of this, cycle.
All right, Peter, we will be on to you again very shortly, no doubt. That is Peter Tchir, Head of Macro Strategy at Academy Securities.